Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley neighborhood update for the week of March 10th. What we're going to talk about the economy and what now we're looking at where, the Federal Reserve was talking about a potential recession. Now they're talking about a soft landing because the economy is even doing a little bit better than they felt it was. Remember, they were talking about a recession, and that's why just recently, they came on TV and said, hey, it doesn't look like maybe we're going to have a recession. And what happened with interest rates? Interest rates actually went up a little bit because remember, they lower the rates to pull us out of the recession like they did after COVID, which lit the real estate market on fire. And then when basically they feel everything's going good, they don't lower the rates, they keep them where they're at, though they still expect rates to come down a little bit. Maybe in one of the next times that they meet, either next month or the month after, maybe June, they're talking about maybe they'll lower a quarter percent, which they need to because they're a little bit high right now, in the 6.5 to 7 range, from there. But they're still expecting that maybe we'll hit the high 5s by the end of the year, and you'll see that. So let's talk about the economy and why they feel everything is doing so well. Well, first off, you look at the Economists and look what in January 2023, it's an exact reverse. 61% a year ago thought that we were going to go into a recession, and 39% didn't think. Well, now only 39% feel that we might go into a recession, and 61% don't feel that we will. So it's a complete reversal of where the economists were a year ago as far as the chances of going into a recession. And the unemployment has been one of the big things. I mean, we hit record lows with unemployment. That was one of the excuses that the Federal Reserve used for not lowering the interest rates, because they literally had a situation where interest rates would, they said if, once they raised them, they basically tamp down inflation. They said, well, if we can cut inflation in half, we can lower the rates back down. Well, it cut less than half, but then what happened is you had a situation where now they said the unemployment was so low, people had money, and they were afraid of inflation taking off, so they kept the interest rates up a little high. Well, when you look at the unemployment, obviously down to, they were expecting right now it's just a little bit over 4, and they're expecting it maybe get up a little bit into the 4s, but for the most part, all the way through 2026, they expect it to stay below 5%. And look at the foreclosures. People talk about foreclosures because they've actually gone up. But they've gone up from 2021 where there's a moratorium. But when you still look at it, they're still almost 250,000 short from where they were in 2017, 18, 19, which they kind of considered the last normal years. So foreclosures are very low. And why are foreclosures so low is because people have so much equity in their home. Look at the consumer confidence in home prices. You can see that during the pandemic, there was a huge amount of them that felt that basically the home prices were going to go down. And then when there was talk, once interest rates went up in the second half of 2022, they were talking maybe another 2008 crash again. And you can see that people thought home prices, they didn't have a lot of confidence in that home prices staying high. And then you've seen those bars go down and down and down and down, where now most people don't feel that the prices are going to go down. They feel that they're going to go up. Matter of fact, that's what all the economists look at the final 2023 home price appreciation rates. Case-Shiller, CoreLogic, Black Knight, Freddie Mac, Fannie, all of them come, I mean, they're all different because they gauge off different, data. But for the most part, for any place from 5.5 to 7% was the appreciation in 2023. So literally, where a lot of people thought in 2023 prices were going to go down, we had appreciation, which they expect again this year. Look at the month-to-month change in home values from the Case-Shiller. In January of 2023, prices actually went down a little bit, but across the board, they were positive for the next 11 months. And it isn't just in California. This is the first time I've seen this chart where there hasn't been one of the 20 city index that the Case-Shiller uses. This is the first time I've ever seen it where none of them were in the negative. There was always a bunch of them in the negatives. Well, this is the final 2023, and the cities across the United States, there's not one that had negative appreciation. So this is countrywide, the prices are staying strong. And the percent of annual home appreciation, you can basically see that, 5%, 4.86 is that dotted line going across. And you can see last year we were well over that. And going all the way back to 1980, the only time we didn't have appreciation was obviously during the recession, 2007, 8, 9, 10. And you see it on the chart there. So you can see obviously in 2021 it was way up. It came back down, but it's still, the average has been above the average. So again, as we talked about before, 5.5 to 7% appreciation in 2023. Here's the forecast for 2024 price. Well, if you look all the way across, Goldman Sachs, Mortgage Bankers Association, Fannie Mae, Zillow, Freddie Mac, NAR, National Association of Realtors, they all expect prices to go up. They average like 3.2%. So not only did they go up 5 to 7% in 2023, but they're expecting another 3 to 4% appreciation in 2024 because we still have a lack of inventory out there. And then estimated home price performance all the way from 2024 through 2028, they're expecting appreciation for the next 4 years. Because the bottom line is we have a lot more demand than we do supply. They say we're 6 to 7 million homes short in the United States. That's not going to change overnight because people are still going to be that. Yeah, rates might go down a little bit into the high fives, but they're not going down. 72% of the people have interest rates less than 4. So a lot of those people are locked into their home. And plus we have the millennials at the peak of their buying season. So basically there's a lot of demand and not a lot of supply, because people are just not moving with the low interest rates. I always tell the story, like in my neighborhood where I'd go down the street and I literally would see, for sale signs. I don't see for sale signs, I see contractor trucks, because rather than losing their 3% interest rate, they're fixing up the home that they currently have. So let's really look at the market where we're at, and you can see it in the San Ramon Valley. Look at San Ramon. That we've seen the inventory go up a little bit, but look at the pending sales. The pending sales are outpacing. We always talk about if you have half as many pendings as actives, it's a seller's market, even with half as many pendings. Well, in San Ramon, you actually have more pendings than you do active properties, and almost everything is getting multiple offers. There are a few that you actually see that it's either going to get multiple offers or you're going to do a price reduction, because if it doesn't sell right away, it means that it's priced too high. And I've never seen anything like that in my 46 years in the business, where you literally have multiple offers but then price reductions. The reason why, a couple years ago when interest rates were 3%, people would buy anything for 3%. But when you get up close to 6.5%, 7%, people aren't willing to pay the high interest rate for something that needs a lot of work, that's overpriced. So there are still some things not selling, but for the most part, if it's priced right, shows nice, it's going to get multiple offers, and you can see in the San Ramon market. Danville is really kind of scary this last week because you saw pendings go way up and actives go down. So what that means is the actives aren't keeping pace with the pending sales. Now, hopefully, as we get closer to the summer, we'll see more inventory, which we need more inventory on the market. But right now, it's a scary market because you have a situation where the pendings are outpacing the actives. Same thing in the Alamo market. You can see that the pendings are outpacing the actives. And certainly in the Dublin market, actives are down, pendings are up. So across the board, pendings are outpacing actives, which means that the backfill of active listings aren't keeping up with the sales, which just means that the market's going to get worse if you're a buyer as far as that. Matter of fact, I always sit there and say, I'm not overly concerned that the rates aren't going down, because if the market's this hot with rates at 6.5 and 7, can you imagine what they're going to be, if they went down into the 5s? It would even be more nuts than it is right now. Hopefully after spring break, as we get towards the summer, we get more inventory on the market. But again, I would still say that it's a good time to be a buyer, because you know, we talk about marry the house and date the rate. Get the house that you want, because if interest rates do go down, which you're anticipating, home prices are going to continue to go up. And then you can always refinance, buy the home that you want right now, and always refinance when rates go down a little bit. And you look at the sold list, the list price percentage. I mean, you can see the last 3 weeks, it's been well over 100% of asking, because almost everything is selling with multiple offers. When you get multiple offers, you're going to get more than asking price, you know, for the home. So anyway, it's definitely a tough market out there for buyers, but I would still be a smart buyer in this market. Every market's a little bit different, so if you have any questions at all, don't hesitate to reach out, because again, every neighborhood's a little bit different, and even each house, and prepping a house to get it ready to get top price is important, because again, people are getting multiple offers, but if your home doesn't show well or priced right, it's going to sit on the market. You're up going to get less than what if you would have just priced it correctly in the beginning. So don't hesitate to reach out. Joe Kehrig, the Kehrig Real Estate Team. Give me a call, 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website to take a look at, learn a little bit more about us and take a look at all of our current listings. www.kehrigteam.com. Make sure you subscribe, tune in, and we'll be with you another week, because right now the market's very fluid. We want to keep you up to date with what's going on. Have a great week. We'll see you next week.